everyone, welcome back to the show. My name is Mike, this is my whiteboard, and today we're going to be talking about the checklist for a short straddle. So I've covered a lot of different strategies, and really what we do in this segment is we look at these strategies, we define what they actually are, what sort of assumption we have, what we want to do, whether it's in a high IV or low IV environment. So we're going to do the exact same thing today with a short straddle. So let's get right into it. We'll define the actual strategy and we'll show you what we like to do with this. So when we're looking at a short straddle, when we're talking about a straddle in general, what we're doing is we're placing an options trade, specifically selling two options, a call and a put, on the same strike and same expiration on that actual stock price. So regardless of whether the stock price is just above or just below, we're going to choose the closest available strike to that stock price. So in this example, we're assuming that we are right on top of that stock price and we're going to sell a call and a put on that same strike to give us a large credit and give us this neutral range-bound profit zone right here. So when we're looking at a short straddle, it's basically a delta neutral, undefined risk strategy where we want the stock price to pin our short strikes at expiration. There is a pretty big difference between a straddle and a strangle in the sense that a strangle, we would have our strikes out here. So I would have my short call maybe somewhere along here and my short put somewhere along here. But since we're selling these options right on the stock price, and as we know, extrinsic value, which is really just time and volatility value, is always going to be highest in the at-the-money options. We're going to be selling these at-the-money options, which just means that we're right at that stock price, and we're going to be collecting a very large credit in doing so. So instead of having our short strikes out here, where they're completely out of the money and we have a high probability of success, we get a higher probability of success in this strategy, just in terms of comparing it to buying stock outright, because we're collecting that large credit, and that large credit moves our break-evens way out here, even though our strikes are right here. So we're going to talk a little bit about that, some of the benefits and some of the cons of that, but really what we want to make sure is that we've got a neutral assumption when we're deploying this strategy. We can't really skew this in any direction unless we move these strikes entirely to the upside or move them to the downside where we might need that stock price to go to those strikes, because at the end of the day, this strategy is going to be most profitable when the stock price is right at our short strikes at expiration. Now, just like any other premium selling strategy, we want to be doing this in a high IV environment. Implied volatility is really just an indication of where the implied move of a stock is given the activity in the options market. So if we're looking at an implied volatility of 20% on a $100 stock, that means that over the year, there is an implication that this stock could move from 100 up to 120 or from 100 down to 80. So we have that range between 80 and 120 if we have an implied volatility of 20. And that is given on a probability or a one standard deviation basis. So we have about a 68% chance that our stock price will move between 80 and 120 over that course of the year. So that's what we're really looking at with implied volatility. But another factor with implied volatility is just a gauge of the option activity. So when we're looking at implied volatility, the higher the implied volatility is, that means that there must be higher option prices, because when we're looking at how we calculate implied volatility, we basically look at all the other inputs into the Black-Scholes model and we try and solve for this implied volatility value. And one of the big indicators is options price. So the higher an options price is, the higher the implied volatility will be. So when we're looking at selling options, of course, we're going to want to be doing this in a high IV environment, because that's going to mean we're going to be able to collect a lot more than if we were to sell this strategy in a low volatility environment. So again, when we're looking at this strategy, we want to be deploying this in a high IV environment. So what can happen when the stock price moves or maybe doesn't move? Well, on the next slide, we're going to talk about that. So the very first thing we're going to look at is what happens when the stock price goes up. So I've got the green section here as the best possible scenario, and usually I would mark these as red because they would be bad scenarios. But just like a strangle, the stock price can move up just a little bit or move down just a little bit, and we can still be profitable as long as it doesn't breach our break-even points, which I've marked with these vertical lines here. Then we're still going to be profitable. if I can break even at this point and the stock price only moves here, I'm going to be profitable by the difference of these values. And just like on the downside, if my break even is here, which just means that I haven't made any money, but I haven't lost any money at this point. If the stock price moves down here, then we're going to see a profit in the difference there. So if the stock price goes up, there's going to be a few things that are going to happen with these options. The very first thing we want to look at is what's going to happen with our call option and what's going to happen with our put option. If we remember, a put option is just the right to sell 100 shares of stock at a certain stock price, but that's for the buyer. And when we're looking at a call option, that's the right to buy 100 shares of stock if I own the call. But since I sold both of these things, and as you can see, those are differing situations and differing assumptions. When I'm selling a put, I have a bullish assumption, so I actually want the stock price to go up. But since I'm selling a call against that, where when I'm selling a call by itself, I would actually want the stock price to go down. When you see stock price movement when you're selling something like a straddle or even in a strangle where we're selling these two options together, when the stock price moves, you're going to see one option gain value and one option lose value. And one of those is going to be good for us as sellers, and one of those is going to be bad for us as sellers. So if the stock price goes up, one thing we need to note is that the call price is going to increase. But since we sold that option, an increase in the call price is going to be bad for us. If the stock price moves up, the call option is going to move in the money, and it's going to have intrinsic value, which is why that price of the option is going to move up. If I sold something here and the option prices moves up and I have to buy it back at this higher level, the difference there is going to be a net loss. When we sell something, we want the stock price or the actual option price to go down in value so that we can buy it back for a lower price. It's just like if I were to sell something for $20 and I can buy it back later in time for $10, then that $10 difference that I was able to sell at the beginning of that trade is where my profit would be. If I sold something for $20 and then I was forced to buy it back later for $40, I would have to shell out another $20, which would be a loss. So that's how we think about this when we're looking at selling options. So the call price would increase, which is going to be bad for us. But the put price is going to decrease, which is going to be good for us. So again, as long as our stock price doesn't move farther than our break-even point, at expiration, we're going to see profit. So it's really important to remember that when we're talking about this strategy here. So what happens if the stock price stays the same? Well, there's a few things that can go in our favor when we're looking at this. Number one is going to be theta decay. Theta decay is just an option, the rate of decay of an option price. And if you missed my whiteboard on theta, I strongly suggest you check that out. You can just click on Find Shows at the top of, or you can click on the magnifying glass in the upper right corner and just search for theta whiteboard and you'll see it there. But when we're talking about theta decay, we're really just talking about the rate of decay of an option's price. And since I sold two options that are at the money, we're going to see these options decay over time, but it is really important to note that at the money options tend to hold their value the longest. So when I'm selling this at a 45 days till expiration window, if I go from 45 days to 20 days, I might not see as large of a profit as I might think. But from that 20 day to 0 day window, I'm going to see a pretty large profit because at that point, my at-the-money options are going to be holding their value, but as we near expiration, there's not much more value that we can hold because all options at expiration are only going to be trading for intrinsic value. And since I sold these options for extrinsic value, since they're not in the money at all, as long as I sell it right on that stock price there, then this value has to dissipate from these options at some point in time. And usually it's going to happen if these options are still at the money in the later cycle or when we're looking at the later half of that cycle of our expiration. So theta decay will be working for us. Both contracts will lose value, but another thing I want to point out is the implied volatility change. We have the highest Vega values in those implied volatilities of the at-the-money options. So when we're looking at Vega values, it's just the rate of change of the options price given a 1% change in volatility. So if I've got a very big exposure to volatility changes with at-the-money options, that's also going to be one thing I want to consider, but we'll talk a little bit more about that on the next slide. So when the stock price goes down, I do want to point out that it's just going to be opposite of when the stock price goes up. If the stock price goes up and my call price increase but my put prices decrease, it's just going to be opposite when the stock price goes down. My put prices will increase because they're going to be moving in the money, and my call prices are going to be decreasing because that call is going to be moving out of the money. So it's just the opposite, but again, as long as the stock price doesn't move further than this bar here, which is signifying our break even, then we wouldn't lose money. And that's really the goal. We want to have our stock price stay within this range at expiration for us to be profitable, and we're going to be most profitable if the stock price is right at our short strikes, because that allows us to allow these options to completely expire out of the money and worthless, but they would have to expire exactly on that strike price. Otherwise, we'd have to buy one of those back for a small value, but as long as that value is very small compared to the overall credit we received in the original trade, that's going to be profitable for us. So what are some tips that we can look at with this strategy? Well, the very first thing is really calculating that break even that I've been talking about. So all we need to do is remember that when we're collecting premium, that premium is always going to offset or help us offset any losses we might see or any stock price movement we might see. So when we're calculating our break even, all we want to do is look at the total credit we received and use that credit as a basis point for where we move our break even from our short strikes here. So for the put side, all we'd have to do is look at our strike, and for the put and call, our strike is going to be exactly the same since we're selling the straddle where we're selling the same strike with both of those options. But we're going to be doing different things with the credit. So if I know that the credit is going to benefit me in terms of moving my break even, when I'm looking at the put side here, I would subtract that credit value from the strike. So if I know that when the stock price moves down, my put's going to go in the money and I would have to buy that back at expiration for a certain value, then I would take that credit and I would subtract it from the current strike price. I would do just the opposite for the call side. So since I know when the stock price goes up, that's going to move my call in the money, which means I'd have to buy it back for a certain value at expiration. And I'd have to use that credit that I originally received to buy back that option. To determine my break even to the upside, I just take my call strike and I add that credit that I received originally. So let's pretend this is a $50 stock and I collected $5 for selling this straddle. If the strike was right at 50 right here and I collected $5, I know that my upside break even would be at 55 and my downside break even would be at 45. So I would have a $10 window there to be profitable, because regardless of where the stock price moves within this window, as long as I would be paying less to buy back one of these options at expiration, since only one of them can be in the money, then as long as I'm buying back that option for less than $5, the difference between what I collected, $5, and the amount I buy it back for will be the profit that I see on that trade. One thing I did want to point out is that IV factor and the Vega factor that we're looking at with these strategies here. So Vega is going to be highest in at the money options. So basically, when we're looking at trading this in a high IV environment, we might look at the difference between a straddle and a strangle in a high IV environment. And when we're comparing the two, if we have a super high IV environment, we might see more profitability in a straddle compared to a strangle because of the fact that a change in implied volatility, or if I see implied volatility spike as high as I've ever seen it before and it ends up coming down, that's going to reap more profitability in the straddle than it would in a strangle, especially because we're collecting a much higher credit value. And if at the money options have a larger Vega exposure, then we know that changes in implied volatility, especially when they contract, it's going to affect these at the money options more than it would if I were to be trading a strangle, which would mean my options would be out of the money and they would have a lower Vega value. So when we're looking at this strategy, this one's going to be much more beneficial from a IV change standpoint. When we close this strategy, it's a little bit different. Normally when we're looking at selling premium, we look to sell and close our manage our winners at 50%. But when we're looking at this strategy specifically, since we're dealing with a specific strike and we have a pretty tight range of profitability, and the fact that we're collecting a lot more than we would for selling something like a strangle, we're going to be okay with closing this at 25 to 50% max profit. We probably won't see 50% max profit until much closer to expiration, but we would be able to probably see 25% or maybe 30% pretty quickly along in that trade. We wouldn't have to wait so long down that expiration cycle. And again, extremely high IV is going to be most beneficial for this strategy, and we're still going to look at that 45 day till expiration time frame, as that's where we start to see theta decay accelerate, which means that these options are going to start rapidly decreasing in price. So let's wrap all this together with some takeaways for you. The very first takeaway we got is that this is a neutral range-bound strategy, just like a strangle, but instead of selling out of the money options, we're selling at the money options for a much larger credit. Vega is highest in at the money options, so because of that, this is going to be much more susceptible to changes in implied volatility than something like a strangle would. And again, we do close these at around 25 to 50% profit because of the fact that these options hold their value the longest normally. So we won't usually see that 50% profit mark until much longer along in that trade there. And when we're using this strategy, we're looking at the credit to determine our break even specifically. So instead of a strangle where we know that we have this range of profitability, when we're looking at a straddle, we know that most likely one of these options is going to be in the money, regardless of whether it's a put or the call. But that credit that we received, all we need to do is just add it to one side and subtract it to the other to determine that total break-even range. And lastly, when we're looking for defense on this strategy, if it goes against us, there's a couple things we can do. We can go inverted. I've also done a whiteboard on that, so check that one out. Or more likely, we can just roll these same strikes for duration, as long as we don't have a different assumption and we still believe that the stock price will come to this level at some point in time. So thanks so much for tuning in. My name's Mike. If you've got any questions or feedback, shoot me an email here, or you can follow me at DoTraderMike on Twitter. Stay tuned though, we've got Jim Schultz coming up next.